Hey everybody, this is Halstead and Andrew McMillan with REH CPA. Today we want to talk about cost segregation studies. You know, a lot of you out there own real estate or looking to purchase real estate, whether it be commercial or residential. Sometimes having a cost segregation study can produce a rather large tax deduction in the first year, but you have to be careful with it because it doesn't always provide everybody with a benefit. I got Andrew McMillan here with me today. Andrew, what can you tell us about cost segregation studies?
Yeah, they're pretty common, like you said, in buying real estate, especially if you're Googling ways to save money in real estate. Cost segregation studies usually comes up at some point. So what that is when you buy a piece of real estate, let's say a commercial property, by default, you are going to depreciate, you're going to write off, take tax deductions for that purchase price over 39 years. And you also got to back out the land, but that's another conversation. But you're essentially going to write off that purchase price over 39 years. You don't get an immediate massive tax deduction for it. It's a 39-year write-off. Same thing with residential rental property. If you buy a rental property that you're going to set up as a rental, and you're going to depreciate that over 27 and a half years, so a little shorter, but 27 and a half years. So buying a piece of real estate does not, create some massive tax deduction for you. I mean, it's great. It's a way to, create long-term wealth and things like that, but it's not an immediate tax deduction in that given year by default. Now, a way to work around this is to do a cost segregation study, which is essentially what it sounds. You hire a company to come in and they segregate all the costs out of this piece of property that you purchased. They pull out carpeting, plumbing, fixtures, cabinets, they break it apart, sidewalks, and they break it all apart, and they try to break it down into pieces of fixtures and furniture, things that can be depreciated quickly.
Things with different depreciable lives.
Right, because carpeting is just depreciated differently than the actual structure of the building. So, the default way to do it is just 39-year write-off, but if you wanted to hire a company to come in and find out what can be depreciated over a shorter life, you can do that. And they also can find things that can be, bonus depreciated or written off like in that given year, in 1 year. So
there's the potential to have a big first year write-off.
Yeah, I mean, there's a potential there to buy a building for, say, $500,000 and deduct $300,000 of it in 1 year.
But that being said, a lot of people wouldn't be able to take the deduction to begin with.
That's true. I mean, it's more complicated than that. I mean, it's there. No, it's there. I'm not trying to say it's something you can't do, but there's also a lot of other things that have to be on your side to be able to get that deduction.
Right.
Most people need to be considered a real estate professional. You've got if there's passive income and active income issues that we have to work around. So it's worth having a discussion with your CPA or whoever does your tax return to understand if this is something you're going to actually truly get the benefit of. Because on the flip side of all of this, depreciation is one of those, happy now, sad later type things. It's a double-edged sword. If you fully depreciate this thing in 1 year, just beware, you're not going to get those deductions now in the future. Depreciation is a spreading out of a deduction. Try to evenly spread that out to offset income that you produce over, the duration of owning it. So taking all that depreciation in year one feels awesome. You get a great deduction potentially and maybe a massive refund.
If you can take it.
If you can take it. But in the future, you're going to be paying more in tax because you no longer have those expense
right. And plus,
deductions.
once you go to sell it, there's a thing called depreciation recapture, and it's taxed at a different rate than your capital gain would be. So it kind of the big depreciation deductions feel good now, but they hurt later when you go to sell.
They do. So it's definitely a very something to look at if you feel like it might be a good option for you, because every situation is different. Taxation is highly complex, especially when you're starting to buy rental properties and do cost segregation studies. There could be the person out there that this is an awesome thing for them to do and it's going to work out perfectly. Yeah. So that exists. But
well, not to mention these cost segregation studies, they cost money.
They do.
That's the discussion I have with clients all the time. They'll say, well, am I going to get this deduction in the future no matter what? And I'm like, yes. I said, so you're just paying somebody to get it for you now versus something that you will get for free over time.
For sure. So, I mean, they've got their place at the table, to have a discussion about, but it's not a great fit for everyone. And certainly if you think you're going down that route, we always encourage people to have a discussion about it, because sometimes sometimes I personally feel like maybe not all of those factors have been weighed adequately enough, and the client can get surprised on the back end when they go and sell this property and like, wait, I don't have anything to offset that sale. You know, there's just, I want our clients to be fully aware of all of the ramifications of it.
Yeah, awesome. Well, really good information, Andrew. So if you are looking to acquire real estate and you've got questions about cost segregation studies, feel free to give us a call and we'll see if we can help you understand if it's a good fit for you. Thanks.